Hi, my name is Jim and I was retired. This morning we learned that the year-over-year inflation rate had slowed to 2.6% in November. So naturally, the market immediately started looking for an early Christmas present. In this video, I'll ask how long you'll wait for Fed funds cuts in the new year. If you recognize that as a holiday pun, you'll be right. But before I continue, I'll pause the Santa Claus to wish all of you and your families a very Merry Christmas and a wonderful New Year. Now back to the topic at hand. Most consumers are familiar with the Consumer Price Index, or CPI, which is released about mid-month by the Bureau of Labor Statistics. But the Federal Reserve's preferred inflation reading is the Personal Consumption Expenditures, or PCE Price Index, released by the Bureau of Economic Analysis, and that's what we got today, this morning. Think of each of them as a way of measuring what American consumers are spending on things and services. Now, PCE generally runs a little lower than CPI. So while the PCE was 2.6% for November year over year, the CPI for the same period was a half a point higher at 3.1%. So here's a chart of inflation concluding with those latest PCE readings. The yellow there is the 2.6% year over year for PCE, while the orange is the core PCE, which excludes food and energy, which can be more volatile, and that's fallen to 3.2%. See, it's a little higher than the overall headline rating right now, and that's because energy prices have fallen considerably in the basket. Now, the upper range of the Fed funds rate, shown here in green, has been 5.5% since July. Now, that's the rate that the FOMC sets in its monetary policy, raising it when it needs to contain inflation and lowering it when it needs to boost the economy. Now, it is the upper range. It's actually trading between 5.25 and 5.5 right now. So how soon in 2024 will we see a cut? Well, the CME FedWatch tool now says there's an 85% chance that we will begin cutting in March. And as a reminder, here's the November readings from the Bureau of Labor Statistics, which showed that the CPI in blue had fallen to 3.1%, and the red, this core CPI, excluding food and energy, was at 4%. So now you can see the overall pattern of these rates and where we are with the Fed funds rate. So here's a longer term chart that goes back to 2015, and you can see the PCE inflation rate of 2.6% is clearly heading closer to the 2% target that the FOMC has. And the 5.5% upper Fed funds rate is clearly in what most of us would call a restrictive range. Now, the market, as measured by that CME FedWatch tool, anticipates the dotted line there that the rate for the Fed funds would fall below 4% by the end of 2024, with rate cuts starting in March and continuing through November. Now, compare that, though, with what the FOMC told us. In the December summary of economic projections by the FOMC participants, their median number for the Fed funds rate at the end of 2024 is 4.6%. So while the market expects about 150 basis points in Fed funds cuts in 2024, that SEP median number suggests only 90 basis points in cuts. And clearly, somebody's going to get a surprise in the new year. Hey, Please like and subscribe to this channel if you like entertaining ideas from a DI retiree. I'm not trying to sell a course. I'm not trying to manage money. I'm simply sharing my DIY perspectives to help you prepare for your own DIY retirement. And why is a DIY retiree so focused on inflation and the Fed funds rate? Well, the rates that we earn for high yield savings accounts and the rates that we pay for loans and credit cards are all influenced by these rates. Now, I'm personally watching this carefully because I want to know how long in 2024 I have to lock in the best rates for fixed income in my bucket 1 and bucket 2 of my portfolio. And as a refresher, bucket 1 is 3 years worth of expenses in cash and equivalents. Bucket 2 is another 5 years in income producing assets, equity and fixed income in my portfolio. And everything else is in bucket 3, mostly invested in equity. I will conclude with my standard warning. I am not an economist. I'm not a financial planner. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. Merry Christmas. Happy New Year.